Hello and welcome to another episode of The Full Picture. I'm Vaughan Henkel, Head of Security Solutions at PSG Wealth. I have the great pleasure in having Marthinus Visser, the CEO of Outsurance, with me. This company has obviously been growing incredibly well in South Africa and has now started to expand offshore. And we're going to touch on a little bit later, but it was one of the companies for us investors that looks to be bucking the trend of actually doing a really good job when they go overseas. So over to you, Marthinus, if you can just give us a bit of a background of the company, please.
Thanks, Vaughan. Yes, I mean, we started in 1998, so we're now this year 25 years old, and we modeled ourselves very much on the likes of a Geico or a Progressive in the US, and at the time, Direct Line in the UK. And we saw that type of technology and then the direct model was quite successful in those countries, and we brought it here, and I think through good execution we started to gain good traction. We launched business Outsurance in 2003, but what we learned though was we thought that direct's going to take over the whole world, just like people think digital is. And what we learned over time is distribution matters, and the more complex a product, the more human intervention is required. So our business insurance remained a bit of a niche business, the S part of SME really. Once people have more complex needs, they need it face to face. Our growth trajectory was good, but by 2005-6 we were faced sort of with a choice, either go into other financial services or go and apply our core skill elsewhere. We scanned the world, contemplated. I mean, Brazil was quite high up, but eventually we decided on Australia, and we can touch a bit later on the criteria we used to decide on expansion opportunities. And we launched in 2008. So UE, that's our brand in Australia, is now in November. It just turned 15. And I mean, it's actually overtaken Outsurance in terms of size. So for those who don't know, 58% of our premium income for the previous financial year came out of Australia. For context, the South African market's got 13.5 million cars, and around 4.5 million of them are insured. We have sort of 20% of those. The Australian market's got 18 million cars, and pretty much all 18 million is insured. So that market is just more than four times the size, because bodily injury there is also done by the private sector as opposed to the road accident fund in South Africa, which increases the size of your market. So that business has grown really well. And then towards 2014-15, it started to taper off, and we were faced with a similar decision again. And at that time, this whole platform thing was very current, and everyone thought that just become a platform and cross-selling. And we were also at that time quite worried about self-driving cars and what it might do to our market. And as such, we felt we needed to diversify more out of our core strength. However, by 2019, it became quite apparent that what Elon Musk is telling us, the self-driving car is not coming as fast as he told us. And there's many obstacles. It will eventually come, but not soon. It also became clear that this platform thing, I mean, if you're good at tennis, you're not necessarily a world champion at squash or cricket. You can be good club level, but not world class. And as such, from 2019, we started to pivot back a bit to our core strength. And we started to simplify our business. You would have seen that we started the disposal of Outvest. We're cutting back on some of our life insurance operations. We're really focusing on our core strength. And I think in hindsight, it was a great decision. We revitalized our growth in Australia and in South Africa. We've now had 3 years in a row of double-digit premium growth. I mean, the last year, 20% premium growth. If you consider that we only have 5% market share in personal lines in Australia, we still have significant runway for growth that is not dependent on economic growth or things like that. That's pure runway for organic growth. In personal lines in South Africa, we have very large market share. That's more economy bound for that reason. But in commercial lines in South Africa, we only have 4% market share. So significant runway for growth there. And to come back to the point I made earlier about distribution channels, we did pivot there, whereas previously we only used to be like a call center business. We now digital call center and face-to-face. And that face-to-face part has opened up commercial insurance to us as well. So as I say, 4% market share in South Africa in commercial, less than 1 in Australia. So significant runway in the commercial space as well. And then now we're quite optimistic on a launch in Ireland first quarter next year, subject to license approval, but we're very far advanced in that process. And many reasons to believe why that could also be a good market for us. So while foreign jurisdictions might not have been kind to retailers or so, I mean, I think if you choose the right market, it can definitely be good for insurance. And I think short-term insurance is a very good play. If you just look at it's simple, it's easy to understand for investors, it's cash generative, and if you have organic growth, you get excellent returns in the long run. I mean, we've plotted companies that's done mainly organic growth versus ones that were heavy on M&A. And there's a very strong correlation in long-term returns. If you look at ourselves, Admiral, Geico, Progressive, Qualitas, and companies like those internationally. So yeah, we think it's a very good investment case, and the market has responded. I mean, now that they have direct access to us, our share price is up 50% in the last year. And I think, yeah, that's a simple business, good dividend yield, and good growth prospects. Probably the story of Outsurance. So yeah, happy to take some questions. So hopefully that gave you a bit of context of where we are at the moment.
Marthinus, I mean, you say it's fascinating. I'm just going to start with the business model in principle. You know, you mentioned Geico, which is obviously the Buffett operation, which, and I'm sure you've read his letters cover to cover. And he's a massive fan of short-term insurance because essentially, as long as you get your underwriting experience or you make an underwriting profit, your cost to float is essentially zero. So maybe just a big picture, what do you do with the float? You know, how aggressive is your investment criteria with the float? Because that clearly, you know, your hurdle rate is essentially with an underwriting profit of zero. So you can do very, very well very quickly. But just a broad principle on how you think about that.
I mean, we're absolute huge Buffett fans. And I've got his book here with a summary of all his letters. But one thing which changed a bit, and where our markets is slightly different to the US, is your float depends on two things, the size of your float. One is the percentage of your business that's annual premium. So if you get annual premiums, you get much more of the premium up front and you hold onto that in your technical reserves. In South Africa, 99% of premiums are monthly. So it's basically non-existent. And the second one is really, do you do long tail business? And that's bodily injury. And in South Africa, that's road accident fund. In Australia, it's optional cover. So we started to do that, but it's still early days. So generally, for us we have very little long tail. So if you read Jim Collins's books, Good to Great and Great by Choice, you'll see that Progressive is the other big, strong US insurer, and they actually outperformed Geico the last few years. And one of their smack recipe things is that you primarily make your money out of underwriting. So the float is a bit of a bonus in our case. What also changed it a bit is the new solvency regimes that became quite punitive on mismatching. So in the old days, insurers were able to throw everything into equities, and then the Buffett recipe is also still quite valid. But now you have to hold so much more capital if you invest in equities. So in South Africa, we go up to about 15% of our investments in equities. The rest is much more safe, short-dated, liquid investments, and that allows us to run a lower solvency margin and just have a good cadence of dividends. And yeah, our investors, they probably know better than us how to invest those dividends. So if we don't have very good ideas, we just pay out the dividends.
Marthinus, thanks very much for the education, because it's always been something that's been fascinating me, that whole their business model versus the business model here. The second question is what you touched on in your intro, is you said you have criteria for going overseas. Would you be able to share some of the broad criteria as why you don't stumble and some other industries, they seem to stumble when they go outside of SA?
Absolutely. I think, first of all, as I mentioned to you earlier, you can't generalize and say Australia is a bad market. I mean, it's actually been good for short-term insurance. There's another South African insurer that's successful there. So it varies by market. But I mean, through our success and our failures, we've drawn up a list of criteria. And the first one is typically you want a stable regulatory environment. What we've seen, and that concerned us around some more emerging markets, the moment you come there, you do well, the rules of the game change because some of your competitors are more connected than you are. And as an insurer, that's just a killer blow. I mean, you can't operate like that. So stable regulatory environment, stable government, critical. Then you want a profitable insurance industry. I mean, in some countries like South Korea, for example, it's dominated by massive companies like Hyundai or Samsung, and insurance is just a sideline for them. So they make their money out of other stuff. And if you need to compete with someone who don't make their money out of insurance, I mean, you're on the back foot. So if no one else is making money, we are not going to make money. Then we need an environment where you're allowed to price accurately, because risk selection is very important. So in many Southeast Asia countries, premiums are tariffed. So the government tells you what the premium must be. Then you can't compete. It actually shuts out foreign competition. So that is quite important. Then we need a sizable direct portion of the market, because that's our core strength. You have a much faster feedback loop, better data quality, so that and a more level playing field than where distribution depends on agents or dealerships or other networks. I mean, Switzerland, for example, is an interesting country, but it's like 95% brokers, and if you're not a local, it becomes very, very hard. So the technology makes it easier for a foreigner to come in. And typically one would think all markets are going to become the same. We thought that. It doesn't happen in insurance. Like the UK market is aggregated. They've got 4 massive aggregators there that's dominating the market. But nowhere else in the world has it taken off. And I think there's very good reasons why. But I think legislation, culture, human behavior, I mean, some of those things just mean you can't extrapolate. So when you go to a country, don't assume the distribution is going to change to how I want it to be, or that I can change the distribution. You must be able to make it work with how distribution works in that country. Then you also want shopping behavior. And I think that's the one that caught us out in New Zealand. You had 90% of the market being controlled by 2 players. So you don't have churn of good clients. So you can't grow organically and build up a good base. And you just get the worst clients, high lapse ratios, and you get into a debt spiral. So that's a key factor. And people only shop around if they can save money. So if insurance rates vary a lot, if all insurers charge exactly the same, people don't even bother, because there's nothing in it for them to shop around. I think the English business language also helps. That's another factor. And then there's 2 or 3 that I can't mention, but I think that gives you good context around the general thinking why the biggest market is not necessarily the best market. And to give you a view, we looked at the top 40 markets in the world, and if it wasn't for Ireland, we wouldn't have done this expansion, because there's no other market. I mean, for example, Texas in the US, it's bigger than many countries, because our product is really about wealth, as I demonstrated with the Australia example. But in the US, in Texas, there's 50 insurers, not a single foreign one. And that also tells you something, even though it's not legislated, there's structural barriers. That's going to make it very difficult for you to come in there. And I mean, if you look at the marketing budgets of a Geico and a Progressive, it's like going toe to toe with Tyson into the ring. You must pick your battles in a smart way. If we were to go there, we'll definitely get a hiding.
So Marthinus, I mean, the other part we were speaking about is sort of an underwriting profit. Do you feel that Outsurance has got a competitive edge with its, and I'm going to use the wrong term, its underwriting models, or is your competitive edge similar models? It's just, you do the selling better, you do the customer acquisition and or retention better. Just if you could just expand on that briefly.
Yeah, I would say it's all of the above. I mean, people look at us and they say, for example, in Australia, they say despite no competitive advantage, they made it with brute force. And the reality is, once we've chosen our markets and our products and distribution channels, it's really all about execution. Our strategy is so simple. It's an execution strategy. And it's all those things you mentioned. I mean, squeezing the 1% out of every single part of the chain and optimizing all of those. And naturally, if you've been long in the market, you do build up some moats around your business in terms of structural benefits. We just have much more data and more detailed data than most of our peers, which does help you to become more granular and specific in some of the things you do. But yeah, it's execution. There's no single thing. We say our clients, for them, it's all about price, service, and trust. And if we can optimize those three things, then that is critical. And importantly, it's not product. We don't think complicated products is a win factor in short-term insurance. Maybe in other financial services, but short-term insurance, people want a simple, comprehensive product, and that's it. Because it's a very price elastic and sensitive category, as you said, grudge purchase.
And then maybe we're coming to the end. If I can ask maybe the two slightly more difficult questions, and you entirely don't have to answer them, is that once obviously you've been here, then it's Australia, now we're going to Ireland. Once Ireland's in the bag, and I'm thinking 5 years out, is there another country that would give you more growth after Ireland, or are you sort of running out of opportunities? And then secondly, if you can comment a little bit about South Africa, it appears that, given our economic pressures, the amount of insured cars on our roads, I would argue, is probably going down. And those people that are getting insured are more likely to have an accident against someone who isn't. So the insurer, you take a double hit. So potentially your premiums have to increase by more than inflation. If you can just touch on those two things, and I think that they're somewhat difficult. Up to you.
Yeah, I can give it a go. Most definitely, we'll once we feel Ireland and Australia is in hand, and we'll look at the next opportunity. But it's a fine balance. You don't want to overstretch yourself. Yeah. I think the good thing is that by doing Ireland, we were able to draw on some staff from South Africa, some from Australia, and even a few ex-Outsurance people who immigrated, who wasn't cross with Outsurance, but it felt they wanted to go overseas. Once they heard me there, they put up their hands and said that they love the group, they want to come back. So I think we're able to deepen our talent pool, but you don't want to spread it too thin too quick. So that'll be one consideration. And the other big one is really distribution. There will have to be a market where you get a direct and digital tipping point where we see it as big enough while still ticking all those other boxes. For example, Switzerland tick most of the boxes, but not the distribution one. So should with generational change, people become more digital there and not buy the insurance at the little town with a broker around the Weissbier, then we'll look at that market. In terms of what you're saying about South Africa, I think you're spot on. I don't think there's any real growth in the number of insured vehicles. And while the total number of vehicles are slowly growing, because we never take cars off the road in South Africa. We don't have roadworthy and things like technicalities like that. So the odds of being involved with an uninsured person gradually does move up a little, causing this real growth. Maybe a final interesting one, which few people realize, is also, I think, while short-term insurance is also a good industry, it's just that we set for real growth.
Yes.
Our share of GDP is increasing. Both here and globally. And some of the things driving that is obviously climate change. You see more events, and at the end of the day, we pay claims, and then we have to put on an admin and a markup on top of that. We also see solar penetration go up, and whenever there's big hailstorms, sort of 3 centimeters in diameter, solar panels get smashed. So from our experience in Australia, typically the average claim size is 50% higher for a house with solar. And we've seen the solar penetration ramp up rapidly. In many countries that depended on subsidies. In South Africa, we went from 0 to 20% in a very short period of time based on our base. So that solar penetration is ramping up. And maybe the last one is EVs. EVs cost more to insure. Very slow in South Africa, and it probably will remain very slow for very long. But in other markets, EV is going to give us real growth.
Fantastic, Marthinus. We've taken enough of your time. Thank you very much for it. It's been fascinating, and we look forward to chatting with you over time as you execute on Island and the others. Thanks a lot for being with us.